and welcome. This is the special earnings broadcast, and we are tracking earnings from Reliance Industries. And at the face of it, it does look like a little bit of a disappointment when it comes to, that's earnings. We do have a miss as far as its standalone business is concerned, and also a miss in the operating business when it comes to Reliance Jio. Reliance Retail, however, has shown some amount of strength. But, before I delve into it any further, let me just come across to my colleague Soumeet Sarkar, who is looking at the numbers very closely. Soumeet, let's start off with the standalone numbers. How are you reading into them?
Well, on a quarter-on-quarter basis, the revenue has declined by nearly 1%, where analysts were actually expecting the number to increase by nearly 6.5%. The EBITDA has come in nearly 6% lower compared to last quarter, and analysts were actually expecting a growth of 7%, which could have been the highest in the last 6 quarters for Reliance Industries on a standalone basis. But the number has come in lower at close to 12,871 crore rupees. On the net profit front, the number is lower by nearly 1% to close to 9,585 crore rupees. So this could be because of a weak petrochemical business that the company has seen. If you see the petchem EBIT, that has come in at around 5,880 crore rupees. Analysts were expecting a number to be close to 6,300 crore rupees. So there's a miss of nearly 400 crore rupees on that front. And the refining number now, that has come in pretty much in line with what the analysts were expecting. The EBIT has come in at around 5,657 crore, 57 crore rupees, which is largely in line. And if you see the gross refining margin for Reliance Industries for the third quarter, that has also come in lower than what analysts were expecting at around $9.2 per barrel, as against analysts' expectations of $9.5 per barrel. So all in all, it's a miss on the standalone front for Reliance Industries.
All right, so a clear miss when it comes to the profitability, at least on the EBIT level. But the other all-important number, I guess, is Reliance Jio. Summit. What are you making of that?
So for Reliance Jio, if you see, that also has been a miss for Reliance Jio in this quarter. The EBITDA has come in lower at close to 5,583 crore rupees. Analysts were expecting the number to be close to 6,000 crore rupees. So that's a miss on that front. Margins have come in lower at 40%, as against analysts' expectations of 43.6%. The net profit has come down a tad below at around 1,350, but that is also because of an exceptional loss of nearly 177 crore rupees that the company has recorded in this quarter, related to the AGR payments that it needs to make. So that is on the bottom line front. The miss is because of that exceptional item. But on the operational front, there's a miss of clearly 300 crore rupees that has come in this quarter. The ARPU number, that has come in ahead of the analyst expectations. Analysts were expecting the number to be around 124. It has come in at 128. But this could be largely because of the IOC recharges that the company had introduced in October, and because of the tariff hikes that it had done in the month of December. If you see the subscriber number, that has also come in a bit lower at 37 crore. Analysts were expecting the number to be close to 38 crore for Reliance Jio. So that could have helped the ARPU bump up by around 4 rupees per user.
There's silver lining here in Reliance Retail, but before that, let me get in Gurmeet Chadda, the CEO and co-founder of Complete Circle Consultants, who's joining us on the show. Gurmeet, good evening. Your initial take on the numbers, what's your first take here?
Looks a mixed bag. If you break it up, I think the petchem was expected to be soft. I think if you see the fall in product spreads, if you see the the per unit of polyester and polymer margins, they have been trending lower. And obviously there've also been a bit of a supply glut. So I think it's a little lower than maybe 200-300 crores lower EBIT as what the street was expecting. I think refining looks good. 9.2 is very good, considering that what we have seen last quarter in GRM. In fact, it averaged about 1.62. December actually, it was lower due to the lower fuel spreads. Geo numbers, I think I'm happy with the ARPU numbers. I think a little disappointed with the net subscription addition. I think street was expecting the net subscribers to be added to maybe 2.2, 2.3. I still not got the breakup of the quarter. We just seen the overall number of subscribers right now. So while the ARPU numbers look good, I think maybe a little higher subscriptions would have actually, as you rightly said, would have bumped the numbers. Retail looks good to me. So overall a mixed bag. I think I'll be more interested in seeing the outlook the company has on the GRM in refining and the petchem business, the deleveraging efforts, the InvIT valuation of the geofiber assets. So I think I'll be more keen there. I think the number optically look okay to me.
Hi Gurmit, Soumeet here. Now if we see the production numbers for the petrochemical business, they are stable at close to 9.9 million metric tons, but still the revenues and the EBIT have come down. So this is basically because of the weakness in the product spreads that we have been seeing. Even there are some analyst reports which are saying that the product spreads are below break-even level at current point. So how do you see the outlook for the petrochemical business?
I don't think it improving. I think because, as I said, there is a supply glut across. Also, I think there was some probably hope that maybe the lower feedstock prices and high volumes could probably offset a little bit of softness there. So I think the consumer business will have to do the heavy lifting. I really don't see both the GRM and the petchem business really. If I were to look at a sequential improve on quarter on quarter, there'll be probably see some improvement in refining margins as well. But I think the heavy lifting has to be done by Jio and consumer and the retail business.
Okay, Gurmeet, so, based on your initial take, well, Reliance Industries as a whole is trading at around 1,581. That's where it closed today. Are you expecting a little bit of a contraction coming through? Of course, we're waiting for the management commentary to come in. That may change things drastically. But based on only the numbers right now?
Not too much. There could be some profit taking maybe, and as you rightly said, we'll have to wait for the commentary in terms of outlook. I think the bigger levers for a long-term investor, as I said, would be the deleveraging efforts. What are the capex plans? The guidance they give on the InvIT valuations of the geofiber assets. I mean, the Aramco stake sale, which has been in news. So I think those are bigger long-term levers. So any dip right now in the price, if one was to get, I think could be used to buy the stock at slightly lower levels.
Okay, fair enough. Just hold that thought, Gurmeet. Let's also get in Avinash Gorakshakar of Profit Smart Securities, who's joining us on the phone line right now. Avinash, good evening. Your take on the numbers overall. Let's start with the standalone numbers. What's the view here?
I think broadly, Agam, the numbers are slightly below expectations, and I think market was expecting the petchem business to show a dip in its profitability. I think possibly I don't have the complete breakup, but what I've been told is that apart from the petchem business, the telecom business has also not delivered. But overall, I would believe that this is a company where possibly there are several levers like the Aramco deal. Typically, which now has got involved in some legal issues. But overall, I would believe that the kind of business opportunity on the telecom side, plus the kind of client additions Jio has done in the last month, I would not be surprised that the stock may not react extremely negatively. But any dip should be used as an opportunity to accumulate. I would believe that better numbers could be expected both from the oil as well as the telecom business maybe in the second half, comparatively, typically maybe the Jan to March quarter and FY21. And hopefully, once the Aramco deal happens, I think that is going to be a key trigger because, a lot of analysts were expecting that this cash flow would obviously improve once the leverage on the balance sheet actually gets, repaid. So I would believe that numbers are definitely a slight miss from what the street expected, but one should not expect a significant sell-off. But yes, any dip should be used to buy the stock, for a slightly longer-term kind of time frame.
So Avinash, Soumeet here. So if you see Reliance Jio subscriber addition, that has come down a bit. In Q3, they have been able to add close to only 15 crores, close to 2 crores, close to 1.5 crore subscribers only, which is the lowest since the company has actually started reporting its numbers. So do you think it is clearly an impact of the tariff hikes that has happened? And how do you see the subscriber growth to pan out for Reliance Jio going forward?
So I think incremental additions definitely, will happen at a slower pace. But I think, if you look at the structure of the telecom player as of now, I would believe that, both Bharti as well as Jio have actually taken a lot of market share from Vodafone. And I would believe that, this would continue for some more time. I would not be surprised that at least for the next 1 or 2 months, considering the kind of tariff price hike, definitely the incremental additions for Jio could possibly be little slower than what the street expects.
Okay.
But clearly, this is not going to happen later on. They would possibly
Avinash,
come out with some further offers.
Avinash, just hold on. I think we do have the management who is going to talk to us at the press conference in just a few moments from now. So let's quickly go across to say what the management has to say.
Again, to share with you the highlights of Reliance Industries' performance in the past quarter, which we shared with the board just a little while ago. This was another good quarter for us. We had the highest ever EBITDA in excess of 26,000 crores on a consolidated basis in this quarter, which of course is a run rate of more than 1 lakh crores annually, or more than $15 billion in dollar terms annually. Our earnings after tax up 13.5% year on year, a record number at 11,640 crores. This quarter was marked by a lot of volatility and a lot of headwinds, and I will talk about them as we go along. But when we first look at the consolidated EBITDA, which I said was in excess of 26,000 crores, the growth came from what is now a familiar story, our consumer businesses, and in this quarter from our refining business. Our petrochemicals business saw trough margins for 8 to 10 years, coming out of a variety of reasons, which also we will talk about. But the integrated energy business consolidated EBITDA was roughly flat. Our consumer businesses grew 12% quarter on quarter sequentially in terms of EBITDA, and our retail business delivered the 15th consecutive quarter of both revenue and EBITDA growth and several consecutive quarters of margin expansion. With this, consumer businesses now account for just over 37% of our consolidated EBITDA. I want to remind ourselves that as recently as 5 years ago, this was less than 1%. From a balance sheet strength perspective, net debt declined sequentially, and for the first time in 20 quarters, our consolidated cash profit has exceeded the capex in this quarter, setting us up on the path of deleveraging. Let me spend a couple of minutes on the macro environment. As all of us know, we saw a lot of volatility in the energy business. We saw price volatility in crude. We had geopolitical issues, which we are all familiar with. And we saw the petrochemical business having the headwinds of a lot of increase in capacity and destocking coming out of the US-China trade situation. With all that put together, 2019 registered one of the lower numbers in terms of global oil demand growth at just about 1 million barrels per day, the lowest that we have seen in the last 8 years. So it was clearly a tough year for the energy businesses, both from a margin point of view and a demand growth point of view. We saw also two other things that affected our energy business. One was the fact that because of continuing situations with both Iran and Venezuela, the heavy crude markets continued to be very tight. And again, because of sanctions, we saw freight markets for oil and oil products also tighten significantly in the middle of the year. So two other headwinds, both in terms of heavy crude availability as well as freight markets. If that was not enough, there was a lot of anticipation that the IMO 2020 will see a surge in diesel margins in the fourth quarter, which we have yet to see. We did see part of the effect in terms of the lower pricing and spreads for fuel oil, but we have to really see any appreciable improvement, neither demand for gas oil or gas oil margins. So in sum, I would say that global factors, both geopolitical and specific to the industry, raised a lot of headwinds in this previous quarter. When we get back to the Indian market, the good news was that we saw a strong rebound in demand for petrochemical products, both polyester as well as polymers. Both registered solid double-digit growth over same quarter last year. Having said that, the previous year was a low base. In terms of demand for transportation fuel, also in line with long-term averages, with gasoline at 7% and diesel at about 2.5%. With that, let me talk a little bit about the highlights of our energy business and its performance. Clearly, with all this going on, we did what we could, which was process the highest amount of petrochemicals that we have ever done in a quarter at 9.9 million tons. We used the maximum of the feedstock flexibility that we have in improving the margins, and we also were proactive in terms of our crude sourcing, given the volatility in the markets and the tight crude markets. With all that, we still had, as I said earlier, trough margins in petrochemicals, 8 to 10 year lows, and I will talk about specific numbers soon. As far as GRM is concerned, we had a healthy number of $9.2 per barrel, better than the last 4-quarter average of $8.6 per barrel. In this quarter, we saw a 69-quarter low, which is a long time in terms of Singapore complex margins at $1.6 a barrel, coming entirely on the back of very weak fuel oil markets. Our spread to Singapore complex was very healthy and expanded a lot, despite the fact that we had weak diesel markets. So all in all, I would say that given the tough environment, we operated well. We placed all our products, operated all our plants at 100%, maximized domestic placement, and did everything possible to improve margins. Jio is a growth story. We know that. The number of subscribers in Jio now crossed 370 million as compared to 350 odd million last quarter. We had gross additions of 37 million subscribers, one of the highest that we have seen since we went commercial, and net addition of nearly 15 million subscribers. As we move to new tariff plans and we move to charging for IUC, we saw a lot of people who were marginal subscribers just using heavy voice slowly go out of the network. ARPU improved a bit over the previous quarter. It's now 128.4 rupees. With the increases that we have seen in tariff from December, we see this will start getting reflected in the ARPU numbers in this quarter and beyond. What is gratifying about Jio is the continuing strong customer engagement. We still see 11.1 GB per month, and we still see over 25 minutes per day, that is 760 minutes per month of voice being the average that the 370 million subs are doing on the network. Another important development in this quarter is that with the new IUC regime and the new our own actions, the Jio has now started becoming a net receiver of access charges within a short period of time. So this is a result of improving traffic mix and the tariff plans that have come into effect in December. From a strategic point of view, as many of you are probably aware, we set up Jio Platforms Limited, a wholly owned subsidiary of Reliance Industries Limited, of which Jio is also a 100% owned subsidiary. So Jio now houses all our connectivity business, and Jio Platform, apart from owning the connectivity business subsidiary, houses now all our digital platforms. And the logic for that is fairly simple. As we have said that there is a lot of interest from a variety of investors who keep talking to us. This particular structure just makes any specific monetization simpler from a structure point of view. Retail of all our business is the hyper-growth business. 15th consecutive year of revenue and EBITDA expansion. In an environment where we are seeing a single-digit nominal growth, we saw in excess of 20% LFL growth in our retail business. We saw margin expansion in virtually all our consumption baskets. And we established several milestones, which I will talk about, both in terms of revenue and EBITDA. We continued to expand our footprint in a geographic way. We added stores. We are now 11,300 plus stores strong. We are now in 6,900 towns and cities, and we opened 456 stores in this quarter. With that, let me get into the quarterly consolidated financials. I want to highlight that the comparison is on a sequential quarter-on-quarter basis. With that, I would say that revenue up 2.5% quarter-on-quarter, primarily coming on back of the growth in consumer business. So digital plus retail revenue on a sequential basis is up nearly 9% to 62,800 crores. PBDIT consolidated is up 1% on a sequential basis. And segment EBITDA, which is PBDIT excluding interest, is up 1.4% on a sequential basis. Net debt is lower by 4,000 crores as compared to the second quarter. And I talked earlier about how cash flows are now exceeding the capex that we are making. Let's now look at the numbers for the refining and marketing segment. Revenue up 6.7% quarter-on-quarter, essentially coming out of higher throughput, 8% quarter-on-quarter in a relatively flat price environment. Throughput was 18.1 million tons in this quarter, and EBITDA was 6,530 crores, 15% higher than previous quarter. GRM, $9.2 per barrel, a little bit lower than previous quarter, which was $9.4 a barrel. But as we have talked about earlier, this was really a quarter with multiple challenges. If we look at the individual products, naphtha was stronger simply because of curtailed supplies from the Middle East. Gasoline was also slightly tighter. Diesel was virtually flat, and so was aviation fuel. So on the product side, we saw slightly stronger naphtha margins, both the other things staying flat, and fuel oil was weak from virtually flat to nearly negative $20 per barrel in this quarter. So with all this put together, we had EBITDA of 6,530 crores. The improvement that we saw in EBITDA of 15% quarter-on-quarter came from continuous optimization in yields as we kept looking at the relative value of each of the products, maximizing the refinery throughput, and being nimble in terms of sourcing crude. Singapore margins $1.6, a 69 quarter low, and premium over Singapore margins an 11-year high, simply because we saw this steep contraction in Singapore margins coming out of fuel oil. IMO 2020 is off to a slow and disappointing start, and as I said earlier, we are really not seeing the wider gas oil margins that were widely anticipated in the industry. We think that this quarter we should start seeing some of those benefits, and we will have a chance to talk about it when we look at the quarterly results for this quarter. Oil demand in India up 3.2% year on year, gasoline 7.1%, LPG 15%, and diesel virtually flat. We continue to have industry-leading performance in our retail outlets, nearly 1,400 in number, and the throughput at 342 KLPM is up 9% quarter on quarter. Let's now look at the numbers for petrochemicals. As we know, this was a tough quarter for petrochemicals. Revenue was down 4.2% at 36,909 crores, entirely on the back of lower product prices across the chain. EBITDA was down nearly 19% to 7,252, and we'll talk about why that is so when we look at the specific deltas for our key products. EBITDA margin declined from 23.2% to 19.6%, a continuation of the same theme of seeing 8 to 10 year trough level margins for key products. Production, we could make up as much as we could and had a record production of 9.9 million tons. So when we start looking at the margins for our key products, polyethylene $292 over naphtha compared to 419, 30% lower. Paraxylene $255 compared to 306, excuse me, 16% lower. PTA $110 per ton compared to 180, nearly 40% lower. And the integrated polyester chain margin also lower by 25% and dipping below $500 per ton. So we are seeing the impact of very large capacity additions in China and a soft demand environment. Excuse me. In this environment, we operated our plants at full capacity, continuously optimized the sales. Let me just share with you where the current margins are and how they relate to 5-year averages. So polyethylene margins are 54% below 5-year averages. Polypropylene, excuse me, is below 63% below. Paraxylene is 32% below, and PTA is 17%. So the margins are lower not just because compared to previous quarter, but also lower compared to 5-year averages. Let's now talk about our retail business. Couple of big milestones. We crossed revenue of 45,000 crores and we crossed EBITDA of 2,500 crores. We continued to expand EBITDA margin at a gross level of to 6.7%. And we opened 456 new stores. We also added within one quarter 1.8 million square feet of retail space. So this has been a very busy quarter for our retail business in terms of revenue growth, EBITDA growth, number of stores opening, number of amount of trading space, and growth across all segments, growth across consumer electronics, growth across fashion and lifestyle, growth across grocery. In the quarter, we saw a record number of footfalls at 176 million, up 26% year on year. We also saw 117 million registered customers, like our loyalty customers, up 11% year on year. And we have built back-end capabilities through 300 warehouses and 300 million cubic feet of warehousing space. In the first 9 months, our retail business profits are higher than the full 12 months in the previous year. Let's look at the numbers for Jio. As I said earlier, we added 37 million gross subscribers, 15 million net. The number as of December 31 exceeds 370 million. ARPU is 128. Gross revenue 16,466 crores. And EBITDA continues to be well above 5,000 crores. And in this quarter, 5,600 crores. Net profit up 36% quarter on quarter at 1,350 crores. Data traffic remains virtually unchanged, slightly higher at 12.08 billion GB. Voice traffic slightly higher at 826 billion minutes. And data consumption per subscriber at 11.1 GB. So I think we can comfortably state that, not only in terms of number of subscribers, EBITDA margin at 40.1%, customer engagement, and the geographic breadth in which now the services are available, we lead the industry. And that is best demonstrated by the fact that we had the highest number of both gross and net adds of subscribers within the industry. So we have announced, as you know, in December 2019, we have announced the new all-in-one offers, which have been priced higher than our previous tariff plan. But given our commitment to provide unparalleled value to the consumers, we are offering benefits in many ways. And the consumers can see it, and therefore we are seeing more and more traction and more consumer accretion, subscriber accretion. We have gone commercial in fiber to the home. We did a lot of initial user tests. Most of the people who now have the service are on a paid plan. We are now ramping up our footprint. We are spreading ourselves over 1,600 cities and are determined to provide this unparalleled service of fiber to the home to as many consumers as we can over a period of time. We are very bullish on the India enterprise connectivity business. As you all know, we have signed a long-term partnership with Microsoft, enabling us to reach out to large and underserved small businesses and micro enterprises market. And when we finally look at the network, we continue to have not just the highest amount of data on our network, we have the best download speeds, and we have 100% network availability. So there is customer delight, there is customer value, and a growing number of people on the network as far as Jio is concerned. Let me now take a minute or two and share with you how we think about our businesses over the next 2 to 4 quarters. I think first I would say from a macro point of view, everything that we hear says that 2020 will be a better year from a global growth point of view, will be a better year in terms of global trade, and the estimates for oil demand growth are already up to 1.2 million barrels per day as compared to an actual of 1 million barrels. That should bring back margins both in refining and petrochemicals, and we should begin to see from trough levels, we should begin to see a recovery and hopefully to mid-cycle margins by the end of the year as far as our petrochemical portfolio is concerned. We still have overhang of excess capacity, but with global growth, we think that that will work itself away. We think that the demand in India will recover into this year, both for petrochemical products as well as for transportation fuels. India continues to be probably the fastest growing market globally of a large size as far as petrochemical demand is concerned. On our domestic gas business, we are working very hard to bring the new project on stream, deliver new gas within the next 2 quarters, and that should be a big development which we will share with all of you as soon as we do it. In retail, the hyper growth momentum, we expect that to continue, and we expect to see several continuing quarters of both revenue and EBITDA growth given the strong momentum that we have. And in Jio, again, we think that the momentum of subscriber addition will continue. We will continue on focusing to provide the best value to consumers and best consumer delight that we can, and grow our business that way. With that, I come to the end of my update. Thank you very much and have a good evening.